Joining me now is Saira Malik. She's now Nuveen's head of equities and fixed income and CIO and chair of Nuveen's Global Investment Committee. It's great to talk to you, Saira. Boy, these three forces that you isolate here absolutely been blowing through the markets. So this is the attempted broadening of the rally, the timing of Fed rate cuts, and then, of course, the election dynamic. So how should investors be thinking about these things?
Well, first, let's start with the rotation, which has been significant. Small caps seeing some of the best 5-day gains they've ever seen in history. This is based on anticipation of the first rate cut, which will likely be in September, and also lower yields and below consensus inflation. I think one question investors are asking is how long can this last? History tells you on average this kind of rotation lasts about 4 weeks. I think what could derail it is tech earnings in a couple of weeks, but the bar is high. And also, as we get to that first rate cut in September, I think that'll be a sell on the news event, and that'll be around the time where small caps discontinue their outperformance, and we may move back to more of a market that we've seen in the past.
So the September you suggest would be a sell in the news event for the small caps or the small cap outperformance trade, and you also suggest tech earnings could complicate that picture. So I guess the question is, if you're an investor who's been largely, passively indexing to the S&P, you're mostly been riding those big growth stocks year to date, past couple of years, what might you do right now to make sure that you have some kind of balance and the right kinds of exposures?
Well, if you look at the market cap weighted S&P, it's trading well above its historical average by about 3 or 4 turns. So I think that's your risk there with just owning the S&P 500 benchmark. I'd be looking to expand from that. Look at the Russell 2000, look at small cap managers. Because if you look at tech stocks and their recent underperformance, that is a drop in the bucket versus the long-term charts for many of these stocks. Just a couple of weeks ago, semiconductors were outperforming software, another tech sector, by over 45% year to date. So there is more room for tech to go down at this point, especially if earnings don't meet investors' expectations.
Is it your expectation that the market is correct in assuming a pretty benign soft landing type environment for the economy? I mean, we've gotten some mixed economic signals, downside surprises, but also things like retail sales holding up better than expected.
Well, that's why I don't see long-term legs around this rotation. I am concerned about weakness around the consumer. We're seeing higher delinquencies with the consumer. Unemployment, we saw claims come in today above consensus expectations. So employment markets are coming back into balance. The consumer is weakening. I think the risk is exactly that the Fed will likely start its rate cut cycle in September, but will it be enough to stave off a recession? I think a soft landing is going to be hard to achieve. We are in the camp that we do see a recession either later this year or early in 2025.
And then in terms of, the election, I mean, I guess you first of all have the typical election year dynamics, if we can say anything will be typical here in terms of, when the market tends to back off a little bit in the late summer, and then, of course, the actual implications of whatever the probable outcome is. So what's the best way to either, tune it all out or I guess, position prudently for that?
Typical election year dynamics are twofold. Markets go up low double digits, and we see increased volatility. We've already seen the markets capture the upside. I think the volatility is what's ahead of us and occurring now. Some of these Republican sweep sectors have been outperforming recently, like financials. I think if we move to where investors think we may have more of a divided government, some of those sectors may unwind or decline. That would be financials, energy. So I think there's still a lot to come with the election and how to position for that. Healthcare tends to underperform during an election year, but as we get closer to the election, it could hit an inflection point. I'd be a little cautious right now, given the run that financials have had.
Yeah, absolutely been a very strong group in a short period of time. So you say you expect a little more volatility for this period. Does that mean substantial downside from here in the indexes? And would you be, I guess, just sort of waiting to make use of those lower prices at some point?
Well, I'm concerned specifically about the S&P 500, given its heavy weighting in mega cap and the fact that the market cap S&P is trading at a pretty significant premium versus history. So areas that we're looking at, dividend growth stocks within equities, they tend to lag in up markets, but they outperform in down markets. These are companies that consistently grow their dividends. And switching out of equities, let's go to fixed income, where I think that's where it's a really interesting segment as the Fed moves to rate cuts. You can lock in now a little bit longer duration in your portfolios. Look at areas like senior loans, where the yields are some of the most attractive within fixed income. Even preferred securities, where the backing is banks. And even though bank stocks have performed very well, bank fundamentals also are very strong. So that leads us to say if you want that bank exposure, maybe preferred securities is a better way to get it.